Tesla shareholder vote to approve. It's the stock split about to get underway. We're watching the count, and we'll get you the results as soon as they cross. Meanwhile, check out WTI crude dropping below $90 a barrel for the first time since Russia invaded Ukraine. The drop coming as fears of a global recession put a dent in demand. Look out, crude futures curve in backwardation as oil traders forecast an even steeper drop-off in prices down the road. So joining us now to talk about what all this means for the energy trade is Citi Global Head of Commodities Research, Ed Morse. So, Ed, is backwardation a really bad signal here because of what it says potentially about demand, about what the global economy will be looking for in terms of energy in the fossil fuel space?
Oh, absolutely. When we had strong backwardation, that meant the prompt price was as much as $40 above the 12-month deferred price, or one month on month, $8 or $10 one month after the other. It's flattened out very quickly, very tremendously. It means the market is no longer expecting tightness ahead. It's expecting things to loosen up. And that's largely driven by what we're seeing on the demand side, especially in the US, but the rest of the world as well. And what we're seeing on the supply side, it's supply purely playing against demand, more supply, less demand. And this is something that has to concern companies, while it is something very pleasant for the consumers.
You know, we are obviously just starting out the month of August, but this can be a pretty active month when we're talking about hurricanes historically. What's the risk there that we could have some kind of a sticker shock if there is a big hurricane that hits a key refining area for oil?
Well, I think you've picked the one major risk that lies ahead in the market. It's a major risk, as we've seen the forecast, the official forecast from the government are for a very active hurricane season. Normally, the third hurricane happens, the earliest it happened before this year was August 3rd, actually. This year, we had 3 named hurricanes before the end of June. NOAA, the official forecaster for the U.S. government, is forecasting not only 21 named storms, but 6 to 10 hurricanes. And 3 to 6 of those hurricanes could be Category 3 or higher. Now, why is this important? In the past, and the last time we had a really significant hurricane season was really in 2020. And in 2020, we had the pandemic effects on demand around the world. U.S. production fell from 13 million barrels a day to 10.2 because of the drop in drilling and the hurricanes. This year, we've seen the world really depending on U.S. production. We started the year with U.S. exports at around 7.8 million barrels a day combined crude and products. A week ago, we had U.S. data showing the U.S. was actually a gross exporter of 10.9 million barrels a day. I think that's a record for any country ever. It's not a net number, but it meant that with the Russia-Ukraine disruptions to supply and dislocations, the world, Europe in particular, has become extremely dependent upon U.S. flows. And that means if we have a hurricane season and we have an active one, and if we have 1.8 million barrels a day of offshore production shut in, or 3 million barrels a day of refining capacity on the Gulf Coast shut in, or 8 billion cubic feet a day of LNG exports, the world will see that pretty quickly. We'd have gas prices going up even to higher levels, and we'd have oil prices quickly turning and going back above 120 or maybe even 130. So we have that dependence on the U.S. right now that the world has never seen before. But it is the one risk in our judgment, the one major risk to really big disruption in supply. Meanwhile, we're seeing much more supply than demand.
We've seen the refiners. I mean, Valero made an all-time high a few months ago. It's pulled off since. What's the sweet spot for names like that, for the refiners and the big cap integrated names? Because clearly they loved higher prices, not so much now.
Well, refiners love the cracks, the margin for taking a barrel of oil and producing product. And that was terrific when we had massively high cracks for both gasoline and diesel. These have come off significantly. The gasoline cracks have really basically collapsed from where they were. That's been an issue that's associated with where our gasoline demand has gone. We were, through December and January and February, seeing U.S. gasoline demand growing significantly year on year. Now, with the latest several weeks of data, we're seeing gasoline demand not only below a year ago, and by that about 1 million barrels a day combined gasoline and diesel, but at the lowest levels that we've seen since 2020. That is really remarkable, and it's a sign of around the world. So the refiners are concerned about where gasoline demand is going, and they are happy that that the price of crude is going down. But without the product demand, they're not going to get the profits from diesel and gasoline.
Yeah, certainly the oil market does look as if it is pricing in the fear of recession going forward here. Ed, thank you for joining us here tonight. Bonawyn, what's your take on the energy trade?
Two things. Hedged versus unhedged production. I think that's going to be a big, create a big disparity between players. And the China story. I mean, we see them open, we see them close, we see them reopen, and I think that is going to speak volumes in terms of, shock to the demand side. Yeah,
that is really a problem for a lot of different companies, of course, and then commodity markets.